Hey traders, welcome to Charts and Coffee. Hope everyone's having a great morning. Happy Wednesday, everybody. We are just one day away from tomorrow's big webinar. If you have not registered yet, please do. I don't want you to miss this. It's going to be live tomorrow at 8 o'clock, simplertrading.com/becoming-consistent. Best URL ever. And what are we going to be talking about other than becoming consistent? We're going to be talking about what kinds of trades, what kinds of symbols, what kinds of tools are we using, right, to handle this current environment. Am I bearish? Am I bullish? Why? Is it gut? We're going to rely on our gauges. We're going to rely on our tools. We're going to talk about that and a whole lot more. And by the way, this is, and I'm just letting everyone know from the get, okay? We have a $7 trial coming up. I know a lot of you have already signed up for it. It includes indicators that we have in the Sector Secrets Mastery. There's a specially curated daily price movement range and hourly price movement range included in the month. So a lot of reasons to come join us for the next month. I'm emphasizing this so much is we don't do this every month. This is not something you're going to see. We haven't done it since a year ago. All right, so I don't want you to miss it. All right, that being said, let's get to it as always. Good morning, good morning. What a ride it has been. And look, yesterday when we talked about the CPI, we talked about what it really was and how we could measure what the real reaction was. Now, I say real and really why? What it really was a flat number. It was 3.4 year over year. Right? But we expected 2.9. So the tantrum came because we didn't get what we wanted. Please, nobody out there think the stock market is this logical, rational, data-driven thing. No, it's a 3-year-old. It throws tantrums, and that's exactly what happened yesterday. We wanted 2.9. We got 3.4. Well, it was 3.4 last time. We don't care. And then we saw the sell-off that ensued. Sell-offs now, if you're wondering, if you've been at this for a few decades like me, you know, sell-offs now happen for the same reason. We've been the same tantruming 3-year-old collective market since the beginning of time. But why are these moves feeling like so much, so exaggerated? And the reason is, well, number one, this is a 5,000 Dow. 5,000 S&P. We're talking about a Dow at 38,000. Go back 20 years and you'll see the values of these, even stocks. I mean, my mom has a double-digit Amazon cost basis. Right? We haven't seen things like this in a long time. So when the price of something becomes larger, so do the price swing. So let's just remember, part of this is organic, right? When we have a 5,000 value thing, 1% of 5,000 is a whole lot more than 1% of the 900. I mean, that's where the S&P was way, way, way long time ago. A lot of you remember, yes? So 1% is a different amount of swing. So that's the first thing, right? The second thing is a little bit more related to the modern markets. We have more eyes on the market that are able to take advantage of infinitesimal moves that really, even just 12, 15 years ago, would have not really been viable business plans. What do I mean by that? We have little, I don't know. I don't want to call them algorithms. I hate that word because it was systems, algorithms, high frequency, whatever the name du jour for the dark at the top of the stairs is. But we have computers now that can do certain things they couldn't do before, speeds at which they couldn't travel before, and they could take advantage of price movement that really wasn't viable. And it's feeding on itself. So if you've noticed, Rob, the price swings are bigger. What's going on? Part of it is just the value's gone up, and the other part is that these computers are more involved than ever. Does that mean these markets are untradeable? Not even close. It just means that more than ever, if you're looking at price and price alone, it's a limited view. It's a one-dimensional view. We have 4 dimensions in the market. Price, for sure, the most important, but volatility, volume, and time. And it's as if most traders are looking at the very tip of the iceberg above the surface. They don't see that mass of action, what's happening under the surface. And that's time, and that's volume, and that's volatility. And those are the kind of things that we put to use. So if you're feeling like, oh my gosh, Rog, what's happening? Am I losing it? Why are we seeing swings like this? It's not that weird. We just have to have a different way of measuring it. That has always been the case. It's just more important now, right? And so that's why I'm super stoked to have this webinar, because the timing, I think, is hitting a point where a lot of traders are thinking, I should be doing well. The markets are moving straight up, have been for over a year. Why am I not growing my account, right? We're not going to talk about the greatest hits of the last 9 winners I had. Who needs that? We're going to talk about wins and losses. I'm going to show you the trades that we put on up until today. So whatever I put on today is going to be in my trades viz, and I'm going to show you my trades viz tomorrow. So simplertrading.com/becoming-consistent. Let's get to the questions as always. Alex, I love this. Naysayers shouting doom and gloom after yesterday, but look at how we're bouncing back. The chuckleheads are back. Now, chuckleheads are FOMC members, and I mean that somewhat endearingly, right? But yes, the folks who are shouting doom and gloom want your attention. They don't want to help you, right? We know this, yes? If I'm always trying to scare you, what's the end game? Well, let me make the decisions for you, because clearly you don't know the mystical, magical things that I know. What are the warnings, right? As I mentioned, if anyone wants to tell you about any warning, they better darn well have gotten you long already and now are warning you. Otherwise, click bait, right? So I agree. Alex, what do we have here? We had the same thing on the 31st. Remember I said yesterday, I said, hey, we traded down into the zone. I do want to get long. I do want to let these we have 3 FOMC members. So if anyone's thinking we're out of harm's way, I will wait for a number of the catalysts, these events, these hot zones to happen, because we have 3 FOMC members today, 1 at the bell and 1 after the bell, which means it's going to affect Thursday. And then I think the schedule was kind of screwed up. BLS has the PPI on Friday. So we still have another hot zone to come that's in that inflation category. Not quite to the impact that CPI may have been, but certainly it's going to continue to give us more opportunity. As active as we were in January, I am very happy to tap the brakes, because the pullbacks are what we need. So for sure, we like the idea of sticking with the long side where the trend is still visible. Yeah, I agree. Now, not everything is still just bullish, right? We don't have that scenario. Everything is not just, bullish, and trends are not in, this is not like 2020 where buy all the things market. That's not it. However, that being said, there are places where the trend is still valid. If you've been following the free videos and Charts and Coffee, of the 4 major averages, if you want to throw the Russell in there, the S&P and the Nas are the only 2 uptrends. The Dow and the Russell are still in sideways trends. So while I don't want to be bearish there, and the Dow's trying to regain the uptrend, see the 2 rows of colors at the bottom, gang? These are showing you the top row is momentum, the bottom row is trend. And you need both. Sentiment, momentum, trend is really what we try to gauge. Sentiment, I can see to a certain degree with the candles. What color candles are dominating, right? Are we above certain levels, key levels, or below? That's sentiment. If that stays consistent, momentum becomes consistent. It's almost like one of those cascading champagne waterfalls, right? So if sentiment remains consistent, momentum can start to gain traction. If momentum gains enough traction, we have a trend. So it really is a cascading effect. So we are generally bullish sentiment, bullish momentum since the 26th of January. And now we're starting to see another flash of a trend. But the trend's been tricky in the Dow. It's not nearly been as unstable in the S&P and the Nas. Far, far, far more stable, because if you lift the hood and you look underneath the NASDAQ S&P, what you'll find is most of the sectors, at least the heavily weighted sectors within them, the heavily weighted stocks within them, are still quite bullish. All right. So, look, it'd be easy for me every morning to key up the mic and the camera and just scare everybody. It's funny, and I think about this so often. Scaring people, that's just evil. That's just evil. I think about that. How can we empower people to make decisions because there are opportunities out there? Don't let folks scare you into thinking things that if you can't see it, right? Learn how to see it, and then you can make decisions for yourself. That's what we try to do in the mastery. We have over, 800 people working together, and that number is growing, which is great. Working together, looking for opportunity. We're not ranting about whatever nonsense. We're sticking with the market. Focus, right? Focused on where are the opportunities and how do we manage risk, and rinse and repeat. The VIX expiry was this morning. I'll tell you, Zane, thank you for that. Yes, so the VIX is a funny contract. It kind of goes back and forth, and it syncs up, as many of you probably noticed, with these rollovers, with these contract expirations. I'll tell you this, and like with most market internals, now take a look at the VIX. This is going back to November. See this Darvis? I know it's a little busy. See that purple Darvis right there? We've been staying in that range. We go to one end to the other, one end to the other. Frankly, I don't use the VIX. Not that there's anything wrong with it, but it's not measuring what we're trading. And hear me out. If you've never heard me talk about market internals, I'm just going to give you something to think about. This is not my opinion. This is actual calculations of this tool. And then you ask yourself, how useful is it? If we know, so by the way, what is the VIX? The VIX futures contract, by the way, is what I look at. I typically don't look at VIX, but VIX is fine too. The VIX was actually introduced by the Chicago Board of Trade. It's been around, if I recall, it's actually relatively new. When I first started trading in the late 80s, early 90s, this thing didn't exist. I think the VIX futures, the volatility index futures, was maybe at the end of the tech bubble. I think that's about when it was introduced, if I remember right. I'm not 100% certain on the timing, but if we think about what it is, right? What is the VIX? It's measuring the market in a way that presumes all the stocks are weighted equal in the indices. Well, you've been listening to Charts and Coffee for any length of time. I don't care if it's a VIX. I don't care if it's a market breadth. I don't care if it's a put call ratio, a tick, a trend. Doesn't matter. The flaw inherent. And whoa, Rog, you're going after that? Dogma, sacred cows. The way that they are measured is not the way the indices are made up. If I have a high concentration weighted index where 5 to 10 stocks are heavily weighted and have a disproportionate influence on what the S&P, NASDAQ, Dow is going to do, shouldn't the internals be measured the same way? It's like me handing you a ruler that thinks that a foot is 8 inches because I said so, right? Be very careful on those. I think it's a cool contract to trade if you'd like. Zane, I'm glad you brought it up because the VIX is a futures contract, just like corn, and you could trade it. But please don't think it's some end-all, be-all, and heaven forbid you think it's a leading indicator. Please don't buy into that. It's a futures contract. It's calculated in a very specific way. Go ask AI, say, hey, what is the VIX calculated based upon? And then get prepared for a good laugh because you're going to say, this is not how the markets actually are made up. This is not how they're comprised. So I like it I think intraday as well. I've noticed intraday, there's some interesting opportunities for sure with VXX, VIX, VX futures. Yeah. So I don't want to in any way undermine the value of it just as a trading vehicle, but please don't think it's some sort of harbinger of things to come. It is not. It is not. All right. 4 dimensions. How do you measure volatility? Oh, so David, how do I measure volatility? Sure. Let's bring up the NASDAQ, for example. So there's a lot of ways that people can measure volatility. I think you can say Keltner would be one way to do it. Average true range would be one way to do it. I use what's known as a PMR, a price movement range, both an hourly and a daily. The difference between them is what data is being calculated and how. So always educate yourself on how a indicator is calculated. Now, with say Keltner or ATR, you set a setting, a period, a look back. It might be 7, it might be 14, it might be 21. What does that even mean? That means that we're going back 7 candles. If it's a 5-minute candle, you're going back 35 minutes. If it's a hourly candle, you're going back 7 hours. If it's a daily candle, you're going back 7 trading days. And then, whatever it is, 7, 14, 21. Those are very common settings. All right. So you look back that many candles. Well, the problem inherent in any cumulative calculation of volatility is that before high volatility events, and you all know this to be true, so now I'm going to confirm it because I've tested it over the years. Don't we oftentimes see that before a major event, volatility compacts, it gets narrow? Why? Because we're in wait and see mode. So if we know non-farm payroll is coming, is there a lot of crazy volatility in front of non-farm payroll, or is non-farm payroll the volatility catalyst? We all know that, kind of guillotine syndrome, right? Who's going to stick their neck out in front of a major event? So a lot of times we'll see this compression, right, of volatility. Well, now go back to 7, 14, 21. Those look backs are skewed, right, by that compression in front of a volatility explosion. It's just a flawed way of looking at the psychology and the rhythm of volatility. So I don't use them, right? I don't use those. What I do use is a different calculation. So everything comes in a calculation. PMRs say, hey, what's been happening over, number one, the last 6 months? Because most of the economic events we see, don't they come around every week or every month or every quarter? So there's a rhythm to their release. So we go back 6 months. And I've tested 1 month, 3 months, 6 months. So 6 months is a really good look back. So now we move forward with the understanding that we need a lot of data to see these repeating volatility events. And then we curate the data differently. I don't need to know what happened the last 7 candles. We're going to look specific to the day or specific to the hour. So the calculation is very, very different. And that's how I measure volatility. That scenario of enough data and then curated in a way that I'm actually comparing apples to apples. I'm not comparing 6 to 7 a.m. to 7 to 8 a.m. I'm looking at a specific hour of the day. I'm looking at a specific day of the week. And that's the difference. The way you curate the data, and then that then triggers these zones. You'll see the gold and the gray or the red and the green on my screens. That's the volatility zones. And they're plotted out there to show us not predicting anything. I don't believe in prediction. All they're saying is most of the time, 68% of the time, this is the range, right? This is the resistance. This is the support. That's its job. And then I'm supposed to make a decision about what I want to do with it. All right. But it's completely automated. I do like that. Okay. Next up is Jay. You were so smart telling us not to buy 6E or 6A yet. It's not smart, but I appreciate it. I'll take it, Jay, but it's not smart. It's just trading what I see, right? We always react. Let the market do what it's going to do, and then we'll react. But I would love to take credit. I probably just didn't have a setup, right? The colors were wrong. The trend was wrong. All the things we automate, so we have a dashboard we can just make decisions based on quickly. Yeah, it probably just told me no, and take a look. We've been in a downtrend since the beginning of this month. So I can't buy, right? What do I want to focus on here? Kind of going back to David's question. In a red zone, the gold, right? That gold upper zone is where we want to look at the shorts. All right. Very cool. Very cool. Very cool. All right. Next up is, bear with me. The VIX was created in 93. Oh, okay. I thought the futures came out in 2003, 2004. I was thinking about the VIX futures, but yeah, so it's pretty recent. Yeah, it's a pretty recent phenomenon in terms of, but even forget about how old or how new it is. I think what's most important about the VIX is when you start to look at the way it's calculated. Don't take my word for it, gang. I'm not here to tell you because I said so. Only our mothers can do that. Go look at the calculation. Then ask yourself, is the way, whether that be volatility, whether that be an indicator, whether that be the VIX, Ask yourself, is that helpful to what I'm trying to do? Is this calculating the volatility of, by the way, the VIX is the S&P. The S&P is a high concentration weighted index. My market internal has to be high concentration weighted as well. Would it surprise anybody for me to say that put calls and market breadth and tick and trend, none of these are high concentration weighted? They are measuring the market as if everything's weighted equally. We know this not to be true, right? So why would I rely on a measuring stick that says a foot is 8 inches? Right. And I think that's what happens. How can an index move higher when all of its highest weighted components are in the red? NASDAQ? It depends on what you're looking at, Alex. I don't have time to get into it, but obviously not everything was in the red. Now, when you say in the red, when it started moving higher, something had to be moving with it. It doesn't have to have all of them going together. All of the Magnificent Seven or all, everything doesn't have to be moving up together. But if enough of them are, I'd have to dissect it because that just probably can't be timing wise true, Alex. So go back maybe and look at the timing of when the NASDAQ started moving up. Something was moving up with it. I just don't have time to get into it now. As always, gang, thank you so much for being here for Charts and Coffee. I'll see you tomorrow, same time, same station. And in the meanwhile, heads up, keep an eye on those economic calendars. Buying opportunities are around the corner. The Fed is still going to cut rates, just not as soon as we'd like, right? So it'll give us some pullbacks to take advantage of. Buy the dip, gang. Buy the dip in those trends. I'll see you tomorrow.